Welcome to this quarter's market update webinar. The second quarter of 2016 has given us plenty to talk about, so we're going to be covering several topics today. This is Brian Cochran. Along with me is John Moore. We're going to hand off back and forth several topics of conversation today, including market trends. We'll also be talking about the U.S. economy and some of the key data that we're looking at as a team. We'll cover a little bit about the Brexit, the uncertainty there, and some of the short-term impacts that we're seeing, as well as the election that's on the front of everybody's minds. Before we dive into those topics, I'd like to hand it over to John to talk a little about an update of our team and what's going on around John Moore & Associates.
Well, good afternoon. I'd just like to keep you up to date on things as they transpire with JMA. And we just extended the lease on our Scottsdale office, and we are very excited about the future in Arizona. So those of you that have friends and family that live in that area, we would appreciate you thinking about us if they need to take advantage of the services that we offer. One of the exciting things in Arizona is that we've hired Greg Hartenbauer. Greg joins us from USAA, the call center in the financial planning area there in north part of Phoenix. And he'll be beefing up our second generation component of our three-generation continuity plan, and actually replacing Britt. Britt is very pregnant. Her baby is due on August 11th, and Britt has made a decision to retire from JMA to be a mom, but continue her studies at Phoenix Seminary, working on a master's degree. The other important piece of news is that Erica, her baby, arrived in May, and Erica should be back in the office in late July or early August. We're looking forward to her return on a regular basis to the office. One of the things we like to do is take a look backward at market returns. We think it's informative. The history is valuable. And the thing that we'd like to point out on this slide is if you look at the one-year number, the S&P 500 was up about 4%. The other parts of the stock market, Russell 2000 is small company stocks. The NASDAQ is primarily large technology companies like Amazon, Apple, and the EFI is 2/3 Europe, 1/3 Japan, and those all had negative returns. So when you look at a diversified portfolio over the past year, did have negative returns, and basically, unless you were in the S&P, has been a difficult 12-month period that ended in June 30th. It is against our philosophy to chase returns. When we do that, all we do is increase the risk in the portfolio. So we have exposure to the S&P types of companies, but we also have exposure in these other areas. It has had an impact on our portfolios. I'd also like to point out over the 10 years that these numbers are starting to look pretty normal, kind of mid to high single digits. Notice the EFI is lagging, and that lagging for this period of time is unusual, but there has been a lot of uncertainty in Europe in particular, and we do think that if we look around the world and look for value, that Europe in particular is probably undervalued, where the U.S. is more fully valued at this point. Not really overvalued, but just fully valued. We also like to look at long-term trends, and we've shown you this chart before. That period in yellow there is a 20-year period from 1975 to the end of 1994, and we just declared that period normal. And over that period of time, the market returned about 8.1% per year plus dividends. And that normal market does not mean no volatility. Right here is the crash of '87, and that represented a 22% down day. So quite a bit of volatility embedded in here. But the idea is that normal returns are around 8%. We got off of that trend line in 2008, 2009, and in the spring and summer of 2009, our quantitative consultant informed us that it was now mathematically impossible to return to that original trend, and suggested that we reset our trend, and that's represented by this magenta colored line. And the most important thing that Virgil Dugan said that day was, don't change the 8.1. That's the correct trend line. And what you can see is we got ahead of trend over the past 3 years, and we believe that was primarily due to quantitative easing. And since that time, we've been working our way sideways to get back to trend, and frankly, we're thankful for that. We were hoping to avoid one of these very steep corrections to get back to trend. And yes, it's been a sideways market for about 18 months, but in our thinking, that could be a much more comfortable way of tolerating the return to trend. There's a saying in the business, the trend is your friend, and the thing we'd like to point out is we're now back to that trend, and we think that's a very positive thing.
So as we move back to trend, we've done so, as John said, in a sideways market. And the last 18 months or so have been a lot more volatility than we've had recently, but also not much return overall. And to put that in context, I love this chart because it takes us back to about the year 2011. And between 2011 and really early 2015, the market had a wonderful run where it was about 19% a year average return, but with about half the normal volatility that we see. And you can see these downsides here. We're about 3 to 5% in most cases. We started returning to what we would consider normal volatility in 2015 and 2016 here. And you can see these two rather W-shaped drops. And what we've ended up with is, again, an 18-month period where markets are quite flat. We understand as an investor that's frustrating. It's easy to become impatient, but it's not a time to break process and go looking for what's doing well. To look at that same 18-month period a little bit closer, here's another chart that shows that, including the more recent drop associated with the Brexit. That's this very quick 5% drop we saw here with a full recovery. And one key thing to look at here, if you look very closely across this line, you can see where we've broken out to new all-time highs on the S&P 500. And we think that's important. The fact that the market has left this short-term trading range and is now breaking to new highs could potentially signal that we're moving to another upward moving market after this 18 months of flat returns.
We've also shown you this chart before, and it's a very significant piece of information here. The significance is that investors pay for earnings. So this red line is the composite of S&P actual earnings. The black line is the S&P index. And right here in the late 90s, you can see that sometimes investors pay too much for earnings. That's a bubble. But since then, we've been tracking very faithfully that earnings line. And notice how the earnings line went flat between 2015 and 2016. And to us, that explains the sideways market that we've been in. And notice how the 2017 number is a substantial improvement in earnings. So if these earnings estimates are correct, and if investors continue to pay for them, it does look to us like we have the potential to move higher. And this breakout that Brian mentioned, it could be the first signal that these earnings are starting to really be important. We do know that investors do look at earnings now. They're looking at 2017, and we believe that's the story that you're hearing. The drag on earnings here has been primarily in the energy sector, and the way that energy companies do cost cutting and that sort of thing. We'll talk a little bit more about the energy turnaround in just a minute, but the bottom line is what used to be a headwind looks like a tailwind at this point.
So to take this back over very long term, just a good reminder in a time of volatility, why do we own stocks? This is a very long-term chart, and it gives us an idea of what the long-term trend has been in the S&P 500. And this is why we own stocks for the long term. You can see a growth rate of about 7% a year. You can add dividends back to that for a higher growth rate, but that's just the capital appreciation or the growth in the price of stocks over this period. And I'll just remind you, I mean, this is going back to the 50s. There's a lot of reasons in here where you would not want to own stocks with world events and things that are going on, and yet the market continues to progress. And while we don't know what the future holds, if we look at history, the story to take away here is that being a stock owner pays off over time.
And also add that there's been a lot of elections.
Yeah. So what's going on with the economy? You know, how could we expect that the market go to new highs? We hear in the press a lot of times that things aren't going that well, and certainly politicians have in their best interest to make it sound like things are very negative. But we see a little bit different picture when we look at our data.
So each week we look at all the numbers that come out, and some of them come out weekly, some of them come out monthly, others come out quarterly. And the bottom line is we have a scoring convention, and because markets run on expectations and investors make decisions on expectations, our scoring convention relies on whether the results are below expectations are above, and a scale of 1 to 5, a 1 means much below, a 5 means much above expectations. And what happened about 8 weeks ago, 7 weeks ago, is we had a substantial, significant change in the average of these indicators. And so it's less important that you worry about what these individual numbers are. And what we're trying to point out with this slide is the composite of all these various inputs of economic data had a significant change from red to green. And notice how for this past 7-week period, we have had an improving green positive perspective. The other thing we measure is the standard deviation, and that standard deviation is a measure of the consensus of these numbers, and that has been decreasing. So that means better consensus, more positive numbers with less uncertainty. In this next chart, Virgil put some formulas onto those numbers so that there's 3 things here. The green is the S&P, the blue is the indicator, the mean of those indicators, and the red is the uncertainty. And you'll see that the trends on the blue have turned positive, the trend on the uncertainty has turned negative. And here's that little breakout that Brian mentioned. Notice how the S&P looks like it has popped out of the range, of the trading range that it's been in. We think this total economic package compared with the earnings, including with the earnings numbers, are part of the reason for the market moving higher.
When we look at the economy, one of the biggest driving factors is the consumer. How is the consumer feeling? Are they spending? Are they spending more each year? And I love this chart to show this very clearly, that the consumer is feeling pretty confident and is out there spending more. We have 2 lines here. The gray line is the growth of retail sales in total, and the red line takes out gasoline sales, which are very volatile. And gasoline sales, even though people are buying more fuel because of the drop in energy prices, gasoline sales are down quite a bit. And what you can see is when we take out gasoline sales, almost 4%. We're at 3.7% growth year over year. What you hear a lot of times in the news is retailers such as Macy's, Nordstrom's, Kohl's, that are coming out talking about closing stores and that their sales are poor. And that really is more true for the traditional retailers. All of the losses they're having are more than being made up for by industries like internet sales, car sales have been very strong, and the one that we always find interesting is a category called food services and drinking places, which has been on a very positive trend. People seem to be spending their extra cash flow that they're saving at the pump and going out and spending money at places like Starbucks or Buffalo Wild Wings. So very strong. The consumer is doing quite well. And that's reflected in GDP. So 70% of GDP is consumer spending. And what you can see here, the black lines here are historical GDP numbers, and the red lines are the forecasts coming from a consensus of various economists. The Wall Street Journal does a poll every month on this. And you can see the average expectation for GDP for the next few quarters is about 2.4%. Certainly not rapid, robust growth, but it's also not a recession. We like to call it the Goldilocks forecast, where it's not too hot, not too cold. We're just in a nice little sweet spot here. So definitely not the dire situation some people make it sound out to be.
Well, here's a little drill down on the situation with oil field. And as we saw supply continue to grow and then prices rolled over, production also started to roll over because the rig count dropped, and basically it's not as profitable to drill for oil, so they're parking rigs or stacking them, is the term that's used, with the idea that until oil prices recover, it makes no sense to continue to drill. And notice there's a little uptick as oil started back from in the 20s to in the 40s. So depending on how oil prices go, you'll see the oil companies make very quick decisions to cut costs or increase their drilling in response to that price. So we want to watch this rig count. The thing that to remember here is the oil prices, and basically the prices you see for fuel at the pump, there may be some pressure on them as the oil prices tend to rise. Most of the forecasts we're hearing are in the 40s to maybe 50s. Raymond James has made a pretty bold statement that they think oil could go even higher than that. It'll be kind of interesting to watch. In the meantime, enjoy the lower cost at the pump.
So the hottest news item as we wrapped up June was the vote around the Brexit. Great Britain leaving the European Trade Union, basically, and the trade agreements there. Significant vote. There was significant surprise when the vote was affirmed they did want to leave, and it shocked the markets quite a bit. And the move that happened on the Friday that the vote was really announced, and then the Monday following, were pretty dramatic. So was the bounce back. It's really hard to say. Again, there's a lot of uncertainty what's going to happen with the Brexit, but one thing we're pretty confident of is that interest rates will remain low as a result of this. And that's because the European central banks have committed to keeping interest rates very low. In fact, some of the high-quality European bonds are in negative territory now. And so what this shows us here, the black line here is the German, basically their version of the 10-year Treasury, and the red line is our actual 10-year Treasury. And what you can see is they trade very similar. It's a global bond market, so investors have the right to go around the world looking for the best deal on interest rates. And so what we're seeing is right after the Brexit vote, our yields plummeted down to the 1.3, 1.35 area. We're already starting to see some bounce back there, but we think that's primarily as a result of the German yields being pushed so low. And again, it's a global bond market, so our bonds become more attractive. Typically, when you see an interest rate drop like this, it could be a warning sign of a recession. In this case, we feel that's not what's being shown here. It's more of a sign of what's going on overseas. Now, the positive on this, if you are a U.S. consumer, especially someone out looking for a home or maybe looking to refinance a mortgage, the 10-year is a very good indicator as to where mortgage rates might go. So we're seeing historic lows again on interest rates on refinancing your mortgage, and the lenders we talk to are swamped with applications for both home purchases and refinance.
We like to track the history of Fed funds, and there's been a lot of talk in the press about when the Fed hikes interest rates that it could be damaging to the market. And the thing with this chart, we go back to the early 80s, and we look at the rate hikes as compared to the stock market. And I would note with you, the Fed funds rate here is in red. The market, as represented by the S&P, is in black. And every time there was a rate increase here, here, and here previously, it actually resulted in a bull market, in an up market, not a down market. And if you think about it logically, if the Fed is willing to increase interest rates, that means the economy's in better shape. Economy's in better shape, the stock market's probably going to like it. And this little tick here is that 0.25% increase that happened. Based on Brexit and things that we're reading, we're not sure the Fed will do another one for a while. Again, time will tell. But the bottom line is it's not the first rate hike we're worried about. It is the last rate hike, because when they stop raising rates, that means they're worried about the economy turning negative, and we'll never know if the last one is the last one for a while. But that's more what we're concerned about here, not the first one. So don't be distracted by that talking heads, if you will, when they start talking about the Fed raising rates here.
So the other big news item, obviously, that all of us are following closely, and it's kind of hard to escape, is the election. And this has been a very interesting election cycle so far. Lots of drama, some surprises. It makes for very good news headlines, but what does it mean for the markets? Generally, the markets don't really care that much. In the end, they're going to be focused more on earnings. We could see some volatility here and there, depending on what the candidates say and what different industries might be impacted by policy. But in the end, we see very few indicators that make us decide one way or the other how it's going to impact the market. A couple things we do find interesting, though, is there's a lot of talk about how poorly the U.S. economy is doing and how the average U.S. citizen is not as well off as they used to be. And this specific article came out in the Wall Street Journal at the end of June that really caught our eye, and it has to do with how many, or I guess what percentage of our population fits into different income categories. So what this chart shows us is what percentage of households can be classified as either poor, middle class, upper middle class, and what you can see is a very strong trend here throughout various political cycles, economic cycles. The trend is really holding strong, where about 13% of our population or of our households were in upper middle class back in the late 70s to early 80s, and now we're up to 30%. And so what this really represents is this lower class, the poor and lower middle classes, have shrunk. They've gone from 24% down to 17% on the lower middle, and 24% down to just under 20% on the poor, and they're moving up. They're going to middle class and, more importantly, upper middle class. This isn't meant to be a political statement, just to clarify, though, that when you hear about everyone's worse off, we just don't see that that's true in this case. And I don't mean to minimize the fact that there's a significant portion of our population the poor, but the trend is in the right direction. And one thing that's interesting is the upper middle class is a much higher tax-paying base than the middle class. So the fact that there's this many people up in the upper middle class, those are people who can spend to drive the economy, provide opportunities and jobs across the economy, as well as pay more taxes so that those folks who are in the lower poor and lower middle class can get the support they need and the opportunities to move upward.
They're also the people that have the ability to be generous, to support the outreaches, that people that have reached into the poor community and help take care of some of the needs there. So it's not just economic activity, but it's a generosity opportunity also.
So definitely a little different than what you hear from the commentators and the politicians. So policy-wise, there's a lot of things out there that are being talked about. There's a lot of issues that will be subject to change during the next administration, whoever ends up as president, what happens with Congress. And there's a lot of disagreement. There's one area, though, where we hope for reform, and we think there's a good chance of reform because there's a little more consensus. And that's the area of global, or of our corporate tax here in the United States. What you can see here, this is a chart that shows the various tax rates of all the different developed countries, and you can see we lead the world in tax rates. Not a good place to be at the top as far as the highest rate. And it puts us in a less competitive situation. It is an incentive for U.S. companies to keep revenues overseas. And what we're hoping for here is possibly two fixes. The first might be some type of a tax holiday where U.S. corporations are allowed a lower tax rate if they bring money back from overseas, and that could bring a lot of capital back to the U.S. and could be a big opportunity for our economy. And secondly, maybe a lower tax rate going forward that will take some of this burden away so that more companies can function here in the U.S. without being burdened with a high corporate tax. So it seems like Democrats and Republicans both agree that these are reforms that need to happen. It's something we hope for. It could be a nice tailwind for the U.S. economy and corporations after the election. So one thing we're hearing about because of the uncertainty around the election, the Brexit, and just general uncertainty around the world is, is gold a good safe haven? We get to ask that on a weekly basis. What do we think about gold? Should we be buying gold? And the advertisers are certainly out there promoting it.
And you've seen all these ads depending on your favorite news channel or financial channel. And the thing that is being used here is scare tactics, plain and simple. And because of the uncertainty and political upheaval, if you will, there's this opportunity to try to get people scared enough to want to put money in gold. And so one of the things we like to study is what's the correlation? What makes gold move? And the thing that we've learned is that there's a strong correlation between gold and the dollar, and it's an inverse correlation, meaning the stronger the dollar, the weaker the gold price, the weaker the dollar, the stronger the gold price. So that's really been a key thing, and with the euro being uncertain, that suddenly maybe makes the gold, makes the dollar stronger, and that might, you might get some gold positive from the uncertainty, but then that negative correlation may step in and cause it to correct. The other thing we like to do is take a look at what historical performance has been. And yes, there's volatility in both of these things, but over the long run, since 1973, gold has returned about 1.5% a year. There's no dividends, and stocks have had lots of volatility, but at least you've been rewarded for that with about a 6.5% growth rate. And that's, again, part of the reason you won't see us talk a lot about gold when it comes to having a piece of the portfolio invested there.
We try to look at portfolios for the long term through multiple cycles, and it's just really hard to picture gold as a piece of that when you look at a chart like this. So thank you for listening in. As always, for those of you who might be listening that are clients, if you have any questions on your own personal accounts, feel free to give us a call or shoot us an email with your questions. And if you're listening to this as a prospective investor looking for an advisor, definitely give us a call, and we'd be happy to talk about how we conduct our planning and build portfolios, and look for another webinar like this coming out next quarter.
And we want to thank you for the opportunity to serve you and take care of your financial needs.